Okay, so in this one we had that. We paid $2 for the debit in this diagonal spread. Yes, it's shorter term, but the receiving the 45 cents gives a $2 debit, but it's a $3 difference in strike prices. Net debit less than the difference in strikes. On power options, let's go back to the portfolio here. I didn't need to do that, but we're going to go into the calendar call spread. We support both diagonals when you're buying an in-the-money and selling an at or out-of-the-money near-term call for calendars, and the horizontals. Same strike spreads on the screen. When I go into the search, I don't know which save search I have saved up here. Okay, this is the initial value search. And down here in the options criteria, this is where I have it set for that debit to strike difference ratio to be less than 1 on my diagonals. So every result that comes up on that screen I know has a net debit less than the difference in strikes. So if I'm assigned early, as we saw in the case where it might happen to me on Trin, the stock's at 34.29, I've got the May 1834 call. So if I get early assignment and my broker exercises the long to deliver the short, I'm at least getting more than the initial net debit back. Okay, and that's the filter that we use here, the debit to strike difference ratio, to make sure that all of those positions have that. There are positions that don't, and the danger we come across is that if we're assigned early in that scenario, then we run the risk of taking a loss on a position where we should have had a high gain, because your long option gained significantly when the stock moved up, but it was countered by the short call in that sense. Okay. All right, I'm just scrolling through some things here. What are the other things you could have done? Well, in general, just like any other position, I didn't on this one, Saeed, but just like a covered call or a naked put, which would be the opposite direction, you may want to consider adjusting your position, of course, if the stock is trading just at or just above your short call strike. Normally mine are out of the money to start with, so it has room to grow. But if it starts to get close to this within 15, 20 cents, if I can catch it, it doesn't always happen. Today I missed this one. Why? Because it gapped up, I think, 45 or 55 cents. So it was at 33.80 at yesterday's close, although it had been moving up. And then today it just jumped up, and all of a sudden in the morning it was above 34. So I left it alone. I might get assigned earlier the weekend on this position. Well, today, you know, at the close, I might get assigned, Saeed, on this position early, or I might get assigned on Monday. It's a possibility. I'm likely going to adjust it on Monday if it keeps moving up. I'll roll the May 18th out. I may even roll the call up as well to lock in, take my risk down from $200 down to about $50 by taking the gain I have in the call already. It's about $1.25. But if the stock starts to approach the position, one thing that you may be able to do if you want to hold the long, but you don't want to close or roll it just yet, in this case, I might buy a May 18th 33 call. Now the price is going to be expensive, but now I've got a bull call debit inside a diagonal, and my broker would take the shorter term option most likely as opposed to the leap. I would check with my broker before that. It conflates the position, it changes it dynamically, but remember, you're doing it to keep holding the long and still get out with some profit. Would it result in a profit? Now, I don't know. I looked at that earlier this morning. I didn't look at it before the close. Oh, I want to go to May 18th. I'm sorry. So I want to buy a 33 for $1.45. Okay, so what's that going to do? That's going to create a bull call debit spread, which actually, in this case, looks good. Because at midpoint, with just these two, the May 18th 34 call I've already sold for 45 cents, which is now higher, and buying this extra 33 call to complete a bull call debit spread, well, my net debit is 1. But if the stock stays above 34, I'll get $1 back. So this is a wash, and I miss out of getting that 45-cent net credit. But if I roll this call, if I buy to close the 34 and move it up to a 35, I lose that 45 cents anyway. I'm going to pay about 78, 80 cents to buy back this 34 call now. Okay, so this is just another idea as opposed to just rolling the short call. If you miss it, you're worried about early assignment. Convert it to a bull call debit spread inside the calendar. it's still an infinite profit and loss now. Why? Because the short call obligation is covered by the new call you just bought. The leap is not hindered and continue to grow. Okay? But again, that's only in the case if you catch it beforehand. All right? And that's sort of the scenario. You can't really bank, you can't really catch early assignment. We talked about this last week. Quick example, a gentleman was in a similar situation that you were in, and a similar situation that I'm in. And what happened is that the stock moved up above his near-term short call, and he didn't quite pay attention to something, and he was assigned Thursday night. So in this case, it would have been like I was assigned last night. His broker did not exercise his leap or his long to deliver the short. They told him that if it was the same expiration, they would have, but because the option was further out in time and not the same expiration, they didn't exercise the long to cover his short obligation. Why was he assigned on Thursday? Because Friday was ex-dividend date. He didn't catch it. So what does that mean? They didn't exercise the long. He had to fulfill the short call obligation where he doesn't own stock, so he ended up being short shares of stock, 2,000 shares or so, I think it was 20 contracts, 2,000 shares. He was short stock to cover that short call obligation on ex-dividend day. So an additional slap to the face, he had to pay the dividend on the short 2,000 shares. My opinion is broker should have exercised the long to deliver the short regardless of the expiration, so he would at least avoided paying the dividend. They made it up to him by giving him some free trades, I believe, but they said they couldn't reverse the stock short. They couldn't reverse the ex-dividend payment he had to make. So they didn't fully compensate him, but I think they gave him some free trades on that. And the good news was the stock kept going up, and he still had the leap. So he kept trading the diagonal spread. Your situation is a little bit worse in the sense that, well, you're out of the trade completely now. So there's nothing much you can do about it in early assignment. You should talk to your broker to make sure that that probably is the best scenario, then being short the stock, depending on the situation. But again, what you might want to do is make sure you put in alerts in to roll the call if it's within 15 to 20 cents. And of course, if you're in a larger stock, the other one I'm in is in Vulcan. The other diagonal spread I'm in, is Vulcan. And that's up at the 130 levels. Or is that? Oh, sorry. 200 levels. So the VMC diagonal spread, yeah, it's a 127, and I'm holding the 130 call, and I'm long the June 115. And I got into this when the stock was at 124, I think, so it's moved up about 3 points. Had a big jump today, a reasonable jump. But my stop in this one, Saeed, is at 129.50. So if I catch it during the day and it goes to 129.50, I'm likely going to roll this 130 call or exit the position if I'm at my mark. My goal profit for the position. Okay, so that's what I'm looking at as far as the management goes. Oh yeah, 130.50 actually. I put it there because I received 55 cents. So I'm actually at 130.50. I'm sorry, I lied. It's at 130.50, not 129.50. I'll be okay taking early assignment here again because the debit was structured correctly. Where it's a 15-point difference, and I'm well under, I'm just at about $9.35 debit with a 15-point spread there. So I'm okay if it gets assigned early as well. Okay. 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 As Sam's looking at the bull puts, he says last 5 days bull put SPY was the best for today's expiration. He's holding Apple calls at 165. I'm just mentioning this right now. I almost hit a diagonal on Apple, Sam, but I avoided it. Okay. All right. Let's get back to the other question. So I hope that helps you, Saeed. I don't know what you can do. I would stay on your broker. I would keep trying to contact them. I would, if you do get in touch with them, I would ask them, is there a way that I can be just short the stock on the margin rather than exercising the long? And when I see that I was assigned and now I've got short stock in the long call, that you can decide personally to close that position or sell to close the call or exercise the call yourself. Try to talk with them through that. I don't know how lenient or accommodating they're going to be, but that's what I would look to do. And just remember, of course, when you get near to the short call strike price, you either want to adjust it to avoid early assignment, may consider that debit spread entry, so that the shorter or same expiration would be used to cover the short and not the leap. And always make sure that the positions you open, the net debit that you pay for that calendar, that diagonal spread, is less than your difference in the strike prices. All right. So we were on the portfolio and I said this might help James. James says, I like your webinars. I like your platform. I am finding it hard to see how it can make money. He says, I'm sure it's my fault, not yours. Okay. Well, the trick is, James, what I'd like to do, of course, I'm going to encourage you to schedule a coaching session next week with Ernie or myself so we can have a fuller conversation regarding what you're doing right now, why you feel you're not making money. Well, you're not making money. So that's obvious. But what I mean by that is it the strategy? Is it your stock selection? Is it your management techniques? And I'm not to say that any of those are bad, that you picked a bad strategy or you picked a bad management technique. We just want to look at it all contained. Okay? As I've said many times during the webinars, and as Sam saw in the webinar, yes, with 50 to 60% of my trading account, I do prefer to trade the radioactive married put techniques. So far, all of the positions I've opened have done exactly what I want. Pulte I opened 30 days ago. The stock itself is up 4.3%. Whenever I open a married put, I look for a stock that I feel has the potential to move up 3 to 6% within the next 30 to 60 days. This position was going to be adjusted. I've got the stock at 30.02 and I have an October 31 put. I'm looking for the stock to hit 31.50. I could have done it today. What I'm going to do is roll the 31 put up to 32, but I'm waiting to see what's called an income method number 5, a ratio spread inside of this with a 31-32 spread. Buy 1 31, sell 2 32s, but it has to be at a credit, and it hasn't been there. But I could just move this up to the 32 strike, cut my risk almost in half, and then sell a 32 call against it. But it did do what I want, as did Goose Holdings. I've been in it 10 days, but it's up 2.4%. The 2 bull put credit spreads I'm in, these were found using the weekly bull put search on April 27th. My bull put screen on the weeklies is 2 weeks out. CMG and EXPA, they both expired for full profit today. The 400, 395 on CMG and EXPE 109, 107. We talked about the calendar spread. Trend needs adjustment, but VMC, Vulcan, is doing the same thing that I want. Interactive Brokers is doing exactly what I want, but too much. I'd actually sold the 75 call, and it ran up the past 4 days to 77, then to 78.80, and now it's up to 79.70. It pulled back today. Well, it went up 12 cents, but it didn't go up $1.10, $1.20 that I have been seeing. So where I'm going with this is these are all profitable positions with the exception of Sony, and that's going to be adjusted next week. At any given time, 50 to 60% of my capital is in the married put techniques, and I'll alternate from bull puts to bear calls based on the market sentiment tool on PowerOptions, and I still do the calendar spreads. And another portion of my portfolio will be dedicated to maybe straddles on earnings, 7 days or 5 day out straddles with stocks that have earnings that week. Yes, I'm going to take the volatility crush, but we're looking for the movements. I haven't actually traded a couple of those in a while. And then occasionally also buy VIX calls. Sam and I talked about that earlier this week via email. He had some good positions on either VXX or UVXY. His was on UVXY. And he had puts on the UVXY, and they worked out really well because the volatility pulled back. I'm seeing the VIX at 13 now, maybe pulled back a little bit more. Now is the time I'm considering maybe buying some 1 month out cheap calls on the VIX as an external hedge in case there is another quick movement in the market. I'm not saying, James, I want you to trade the way that I'm trading. I'm saying I trade this way because it works for me. But the searches that I use the bull put weekly searches when I'm looking for positions. I use the default married put screen, adjusting the stock price and the risk level that's shown on PowerOptions. And the diagonal spreads, we talked about that last week, how I customize those. I'd prefer to talk to you one-on-one about what strategies you're doing on a coaching session, what's not been working for you, so I can point you to the default searches that we used and why we use them, but also discuss the management techniques. Yes, the 2 bull puts I mentioned that I have for Vulcan, I keep getting confused, I'm really sorry, CMG and Expedia, they expired, but I have triggers. And I have management techniques I will use in those spreads because eventually they will go against me. As the bull put spreads that went against me from February 5th to February 9th, lost on both of those. It was countered by the VIX call I had in place. I lost 40% of the max risk on one bull put spread from March 20th to April 5th. That other decline that we had. And I lost 60% of the 100% on the other one because it just gapped away from me. I managed both of those positions. One's at break even, one's still at a loss. I'm going to have to manage them again. Now, the diagonal spreads, of course, I use that search. Where I'm going with all this is that it is my job to curb these fears for you, to show you that there are strategies that can make money, but you have to be willing to be dynamic. You have to move with the market. Sometimes I'm in bear calls instead of bull puts. Sometimes I time it wrong and they have to be managed. I want to get to the root problem of why you feel you're not making money or you're not achieving your goals. I can't meet everyone's goals, but I want to talk about what criteria you're using. Maybe we can tweak the technical criteria. Start using things such as the Bollinger Band or the MACD screens in the PowerOptions search to get you maybe better results or better trending results. Maybe we can talk about what triggers you're using and we can adjust those. Maybe your triggers are too tight. Several weeks ago, we were having that long call discussion similar to owning the long-term leap out in time. And we ran a poll and asked, where would you set your stop on a long call position? This might lead into Andrew's question, which is coming up in a little bit. And the poll, was asking, 25%. A stop on a long call would be 25%, 30%, 33%, 40%, or 50%. Where would you set your stop to close out of the position based on the management? And one gentleman said other on the poll and wrote in and he would put it at 10%. Well, that's what you can do with a stock maybe. In fact, William O'Neill at Investors Business Daily always touted 7% stop on a stock or if you're in a covered call. You can't do that on an option because just the bid-ask spread alone, you're at a 10% loss for some of these positions. Okay, that doesn't work. If I put a 15% or even 20% stop on my long calls, I'm nowhere near the win-loss ratio I need to be successful long-term. I'm closing out too many positions for a loss and not giving it time to grow. Of course, I really don't want to take a 60 to 70% loss on my leap option or my long call either, but sometimes that can happen. And sometimes that happens with the spreads, and it may wipe out 3 or 4 previous trades, more like 6 or 7 previous trades. That's the nature of the strategies. So the goal is knowing that you will take losses in every strategy, fine-tuning the criteria and what strategy you're doing to hopefully find better candidates with our help and what's worked for us over the years, and at the same time evaluating your management in addition to your goals. And I had a customer the other day I was talking to briefly just on credit spreads. And let's just take a look at the CMG profit and loss chart. I think it's already up here. Yeah, here's the CMG. 4 contracts, but it was 75-cent net credit on a 5-point spread. Okay, and it had a probability of about 78, 80, it was about 78, 79% when I opened this position. As you saw, it's a 17.6% return. Why is that important? Well, the customer's question was, won't I do better in my spread positions as the max profit here was 300 if at any time during this position I would have liquidated the spread and taken 150. So 50% of the expected profit. Okay, well, I have a target goal in mind of what I need to make on my positions, my spreads, based on my win-loss ratio. Meaning that if I'm right 83% of the time, I need to look for about a 15 to 17% return. If I'm right 90% of the time, I may only have to look for a better probability positions that only offer an 11 or 12% return. Okay, so that's where my settings are set for the search criteria. But if I now start taking only 50% of the winners off the table and I'm making 9% instead of 17, or 8.5% instead of 7, 8.8 instead of 17.6, okay, now I'm going to need to be right 94 to 95% of the time. But my other criteria and my historical record shows that I'm right only maybe 87. So I'm not going to be successful long term. You have to readjust everything if you decide to take off half of the return when you're ready. Okay? In theory, it's a good practice. Why not take a profit when you have a profit? Shouldn't that increase your percentage wins? It might slightly. But remember, if you're winning 88 to 89% of the time, the ones that you're closing at a 50% gain were already reaching 100% before you started doing it. So you're still closing them for a profit, but that other 12%, 13% you're losing on are still losing 40, 50, 60% on the leverage part of the spread. So by taking the gains early, you might move that meter of win-loss ratio a little bit, but you're not going to jump to that whole new bracket of 92, 93, really 94% when you're only taking an 8% return instead of a 17. Okay? It's tricky, but everything works together. But James, that's what I'm saying. That's what I want to get down to is what are you doing? How are you approaching it? How is it coming out for you as well? Okay? And we want to go through those different ones. Saeed did just ask, is this recorded? He has to run. Yes, this is being recorded. I started the conversation on the diagonals a little bit later, but we got it mostly in there, and it's still recording right now, okay? All right. Sam throws in a comment today. He's looking at health stocks are up after the discussion today, Trump's talk today. Not enough move with the SPY and IWM. We'll have to see as well. And Disney's earnings, of course, with Fox. Oh, that's Rajiv's question. We'll get to that. That's actually a position. So, James, that's what I'd like to see you do. Send me an email this weekend. Give me a call. Schedule a coaching session later on. Okay. All right. Hello. I'm sorry. First off, looks like Sam is out in Myrtle Beach. It came out Turtle Beach, but I think he meant Myrtle Beach. But anyway, he's doing the position in HEAR and had some gains in Facebook as well. I mentioned the UVXY trade also. Okay, Andrew. And then Rajiv's question. Andrew said, is there a way to repair long calls or long puts that go against you? There are ways. I don't have one way because each situation, Andrew, is a little bit different. First, before we get into a discussion, I'm going to navigate over to the free webinars tab as always. We reference this once or twice. And of course, this is a public page. You can see it up here at the top. It's powerop.com/webinars.asp. Oops, sorry about that. All right, and I'll just send that to everyone in the chat window here too. Okay, so this is a public page. Why am I here? There are various categories. PowerOptions tools to help you get familiar with getting started with the search tool, the tools we use to research and analyze a new trade, what is behind our search criteria, and so forth. And then under the options strategy section, you'll have things for managing your spread trades, debit spreads versus credit spreads, an introduction to the spread positions, calendar criteria and calendar spread basics. In addition to that, straddles and strangles for earnings, manage your bear call spread. Where am I going with this? Here we are. Managing your long options positions. Yes, it's 2 years old, but it's the same discussion I would have next week if I was hosting a webinar on Wednesday for managing your long options positions. It talks about managing long calls and long puts that go in your desired direction and do not move in your desired direction as well. So, what may do to manage a position? Let me go here very quickly. I'm just going to go to IBKR. And I'm going to go to the quotes page, and we're going to go back in time. I could look at the chart. But we're just going to go back in time 8 or 9 days. Let's just go back to the 4th. Okay. We'll look at the chart too. So back on May 4th, last Friday, IBKR closed at 74.95. Now it had a good run. It had pulled back. It had run back up. And then it started to move up again. Maybe we're thinking it was going to pull back. So let's go to the chain. And we'll go to May 4th for IBKR. And we're just going to take a look at some, let me submit that first before I do that. We're just going to look at some puts out a couple months when the stock was at 74.95. Maybe I'll go far out to September, okay? So when the stock was at $74.95, the out-of-the-money put was $310. Would have been a really good naked put trade, but normally we're doing month-by-month naked puts instead of going further out in time. But let's say that we bought this essentially for $3.30 on May 4th, which was the September 70. Okay, what happened then? Well, it continued to move up. It's at $79.70 now. All right, so let's take a look at the actual numbers here. What would this be? Let's go ahead and put it into our portfolio. Let's see here, long put. September, oops, sorry, folks. It's over a 50% loss. Let's just put one contract to make the math simple, 1 week ago. And it's okay that it's near a 50% loss. Really, it's not, but it's okay. All right, 330, right? Yep, September 71 put 330. Last week, May the 4th, stock's at 74.95. All right, so here's our long put. We paid $330. It's down $1.18 or 35.6%, not quite 50%. Okay, so we know where we're at now. We're at a 35% loss. Question is, what am I going to use to manage these positions? Well, the position's moving against me. That's obvious. What I possibly could do now is convert this into a diagonal spread, assuming you have time. Assuming you bought 3 or 4 months out. If you bought May 18th expiration and something has moved the opposite direction on a long call, long put, you're running out of time to manage it. It's going to be very difficult. You could try to convert it to a vertical spread. It might not work. Okay, so the stock at $79.90, rather than what I'd really do in a calendar put spread, which is to sell a put below this one because I'm bearish, I may sort of do a mimic of a bullish one. I have to go out to June. It's only 15 cents there, but we could sell the 75 put for about $1.15. Now this is effectively like a bull put spread, and I may have to put up margin to do it, but I've taken the risk down to 215, and if the stock pulls back and is trading at 75, I'm at a gain still, where I might still be at a loss on the 70 put, even out to September if the stock continues to fall. Okay, so what do we have to consider here? Number one, is it time to close the position, move on, and just manage it with other trades? Potential. Just like you might manage a stock that's down, you could sell a put against it in this case. This is with the long put, or you'd sell a call against the long call. The danger, of course, in either situation is you're actually reverse of what normally you'd be doing. Okay? See, I have an obligation to buy shares of stock at 75, and I have the right to buy them at 70. My broker may actually require me to put up 5 points here to cover the difference between the two strikes. That would just add to your risk. But in the case of in the next 20 to 30 days, even if IBKR fell back to 75, I don't know if the September 70 put would be at a profit. Let's take a look. We're going to put our expected stock price at 75. We're going to go to June expiration, the 15th. Yeah, see here, the expected theoretical value of the 70 put, even if it came back to 75, would be 273. You're still at a loss of about 60 cents. But with the diagonal, you'd have a small profit, not what you were hoping for originally. Does it hurt it more to the downside? No, because you lowered your cost on this position. But if the stock really tanks now, drops further and further, where you'd have a profit originally, now you're stuck in a gain. Okay. If you think the stock's going to reverse, if you think the stock, Andrew, is going to go up, you may consider just selling to close the put now, taking the loss, and then buying a call to see it going forward. Okay? That might be something you would do. If you have, Sam points out, here's the other thing I mentioned, if you have time on your hands, then you can do as well. Okay? All right, let me just take a look here. All right, so that's one of the ways to do it. Now, when you have a stock that moved against you, we do offer something called the stock repair. So you bought a stock, it moves down in price. You could use the stock repair, which tries to build a ratio call spread to help you get back to break even. That might be something you could also use for a long call in a position. Okay, so for example, on SNE, let's say I originally bought 100 shares of stock at 50.50. I'll put 52.5. Okay, stock's at about 48.17 or so. So what this tool does is it tries to build a ratio repair where I'm going to sell 2 calls and buy 1 and try to receive a credit. Okay, so even with my cost of 50.25, the stock's at 48.08, lost a little bit there. I see a repair for June where I might be able to buy a 48 call, sell 2 49s, and my break even is lowered to 48.95. Let's take a look at the repair details. So one June 48 call would cost me $1.55, but I could sell 2 June 49s for 95 to take in 190. This is a 35-cent net credit. Well, I paid 50.25. That only drops me to $49. How am I to break even, or $49.90? How am I to break even at $48.95? Because I own this call at a credit. So in this case, if the stock's at $48.95, what happens? I keep the 35-cent net credit. The 48 call that I bought is worth $1. Oh, I'm sorry, it's worth 95 cents. Okay, I paid 50.50 or 50.25, so at 48.95, I'm at a loss of 130. That long call is worth 95. The 2 short calls expire. I have a 35-cent net credit. I'm back to break even with the stock only needing to go to 49. Now, that's the basic stock repair. Hold on one second. It opened up in the wrong window. Let me scroll it over there for everyone. Okay, this is what it looks like graphically. Okay, not a great return if it continues up, but you're at to break even faster. Now, if I hadn't bought the stock at 50.25, but I had bought a June 50 call when the stock was at 50.50 for $1.25, would the repair still work? A little bit. You've kind of created a butterfly here, which might be able to help you on the position if the stock moves back up to 49, and it mitigates some of the loss you might have with the repair. Now, though, you do have sort of a broken wing butterfly on the position. And you own a 48 call, you already own the 50 call, and you sold 2 between. You've essentially created a butterfly to help the repair. I don't know if I like this. It's too tight of a window just between 48.90 and 49.10 to break even, but the losses here are lower if I think it's going to recover. That's the key with all of these repairs for long options, long calls, long puts, or other strategies, is that if you think it's, what do you think it's going to do going forward? X or Y, is it going to continue to move back up? You might be able to repair the call very easily. But if you think it's going to stagnate and move down, it's going to be much harder to repair the call without using a different type of strategy, and more in depth of that is discussed in that full webinar, Managing Your Long Options. Okay, so there are things that you could do. You convert it to a calendar spread, long call or long put. That comes with risk and reward. That's fully explained in the webinar as well. The stock repair may work for you, call or put side, depending on where you think the stock is going to go next. You may be able to do a vertical spread on the position, as something that Rajiv had just mentioned a moment ago for June expiration. A bull call spread might help here. So you can do a bull call spread on the outside, or I might be able to convert this, my long at 125, I might be able to convert it to a bull call if I think it's going to recover, or I might be able to hedge some of the loss in this case by converting it to a bear call spread, which in this case is not going to work, but at least I can mitigate some loss. See, now I'm taking in $1, but I paid $1.25, so at least now, if it stays down or continues to move down, the most I can lose is 25 cents instead of the full 330. I'm sorry, folks. It didn't want to load the graph for us there. It doesn't like graphing, I think, a bear call credit. There we go. So in this case, remember, I could lose the full 125 by selling this call here. What does it do? Well, it just hedges me a little bit. But again, I can still lose 125 if the stock moves up above 50. Some more of that is discussed in the presentation that we mentioned. So there are ways to do it. And of course, in the presentation, we also go in depth through those different positions. In depth and through the pros and cons, I'm sorry, and what your expectation would be. Okay? Convert it to a butterfly. Just create a simple calendar based on what you think the stock's going to do next. The simplest one is, hey, close the position and try to make it back somewhere else. Take the loss. Okay. All right. So we've got a couple of questions from Rajiv coming up. Let's see here, another comment, Sam. Oh, okay. So Sam was talking about a straddle on Apple. That's the 175s. And Rajiv had mentioned I apologize, the Disney position. We'll get to that as well. All right. Sorry, I'm scrolling down to this big question here. I'm trying to read through the long question before I read it. It's from Randy. Okay. So Randy says, let me go back to the portfolio real quick and grab let's grab TRN. This might be what he's referring to, but it might be something completely different. Randy says, I am confused about short strikes in the money and expiration dates. I thought when your short strikes go in the money, you immediately take action. I was listening to a short webinar the other day on naked puts. The presenter was not worried about the short strikes going in the money. He advocated rolling the same strike and that the position would most likely be okay. Randy says he got killed in April. He had 3 credit spreads. One went in the money and the other 2 came really close. You panicked and closed the trades. All ended up OTM. These were on individual stocks. Okay. Now, normally in this case, and we talked about it earlier, Randy, this is a calendar spread where I may not want it to get assigned. And normally when I'm in this situation, if the stock had moved up to 39.90, 39.75, oh, 39, I'm sorry, 33.90, 33.75 or so, I may have looked to adjust this position to avoid it going in the money because I don't want to be assigned. I'm okay if it was exercised early, but I really want to sell it on my terms and close the position on my terms as well. In the sense of, did you say bull puts? You talked about the naked put position. You said you had 3 spreads, credit spreads, and one went ITM, the other 2 came really close. You panicked and closed all 3. Sometimes there's nothing wrong with panicking and taking a loss if you avoid a larger loss. But of course, all of them ended up out of the money. Okay. Same as I did before. I'm just going to go here real quick, talk about the option strategies. Remember, there's that full webinar on managing your spread trades. And what's also discussed in this, not just the 7 to 8 ways we may look to manage a spread, but also the trigger points you'd want to use. Okay? If something happens to a bull put or a bear call, I'm sorry, I'm looking for, okay, let's reverse it. Let's take TRN, but reverse it, Randy. Let's say I was the opposite. I was in TRN, but I was in a bear call for next week where I had sold the 34 call and bought the 36. Number 1 rule for me, in any credit spread, my strikes are always 2 points apart. Okay? So I know you may have been doing bull puts, but the same kind of rules apply. I'm grabbing TRN because it had that jump today where it's now in the money. So I couldn't do anything about this. It closed at roughly 33.80 yesterday, opened today at 34.29. It's now in the money. Now let's see. For this spread, let's make it realistic, Randy. Why don't we do that? Let's say I got 2-point spread. Let's say I got 28 cents here, and this cost me 9. Okay, that's even way too high, really. No, it's good. That's good. It's 10.5% for a 1-week trade. I did it a couple days ago, and then all of a sudden today it gaps up to 34.29. All right. Now, what am I faced with? we saw the liquidation value, the current prices, was 75, roughly, and 18. So if I bought it back now, close the whole spread, 75 and 18, we only got 19 cents in, and we'd have to pay 57 cents to close this position. So it's 19 to 57. Now let's say this is my average credit for a 1-week trade. Average return is really what I'd be looking at, but let's say this is my average credit. This loss just wiped out 3 previous gains. Okay, that's the effect of the credit spreads. That's what happens. And I'm not saying you did anything wrong because you avoided larger losses if it continued down. Unfortunately, hindsight's 20/20. You didn't know that, and it moved back up, and they would have expired. That's okay. All right, so what are my triggers here? Well, it's above now, and it got against me. What are my options? Number 1, close the entire spread, just liquidate it. Try to make it back with other spreads. That's kind of what you're doing, but you took 3 hits at once, so it probably wiped out 9 to 12 previous trades that you've made. Okay, but that is an option. Sometimes I just have to take that and move on. And when is that done? Well, it's done usually when the stock reaches within 1 or 1.5% of my short call or short put strike price. That's my management. If one of your criteria, Randy, for opening a spread is that you never open a spread where the short option has a delta of greater than 0.3, well then a trigger might be if that delta ever gets to 0.4. You'll look to manage the position. But I don't necessarily have to close this one in this case. Yeah, I'm at a loss right now of about 57 cents. Number 1 is I can close the position. Number 2, we could roll, and these are out of order. You'll see another webinar later where it's going to be a different order, but number 1, I could roll the whole spread out. I could liquidate it and take the 57-cent loss, then look for a new spread, maybe 36 to 38, but I'd have to go out to June. And I might make this, oh, it's not even a loss of 57. I'm sorry, I have to pay 57, but I keep the 19. I'm terribly sorry. So really the loss on this is about 38 cents. Okay, so if I roll this spread, I stay in the stock. I just think this was a bad term. I still am bearish on this position. I could roll it out to the 36, 38 out of the money spread, but I may have to go out to June now to get that 38-cent net credit back. Okay, so roll out the entire spread. Number 1 is close the spread, but just make it back with what you're doing, and hopefully you find better stocks. Number 2, roll the whole spread out in time and up in strikes or down in strikes in the case of the bull put. One of the reasons why I always leave 2 strikes apart, and if you have 50-cent strikes, you could sell the 31 and buy the 32, for example, and then maneuver it with the 50 cent. But I always leave 2 strikes apart, or 1 strike between. Why? Because it gives me an extra option to do something. And that extra option, of course, is I can close the short, buy to close the short, and sell to open the next one if it's profitable. So close the short and roll up one. Don't roll both, just roll one. Again, usually would want to have more than 5 or 6 days of time value left in order for this to work. I don't know if it's going to work, Randy, but let me take a look. So what am I doing? I'm going to buy to close this at about 75, and I'm going to sell the 35 at 35. I'm not moving this one at all. Not moving the 36 at all. I'm not going to touch it. This isn't going to work, by the way. But that's okay. What would it look like? All right, so we got 28 cents originally. I had to pay 75 to buy it back. I got another 35 cents, but it's still a loss. Sometimes this will work, though. When the stock moves above or gets to that short strike, you may be able just to move it up 1. And as long as the combined credit of the 2 positions is greater than the buyback cost, you may be in a good position. It's an option. This one doesn't work. Lowers the maximum risk to only $21 if it stays down. But again, that's not what we're looking to accomplish, okay? All right, so it's about the same that we're taking right now in this case. There are other ways that we could manage this position. I could, oh, sorry, let me go back to the main one. Depending on your outlook, Randy, going forward, this happened. You may want to, one thing I could do in this bear call, if the stock continues to move up, if my expectations that's it, is I could close this spread and open a bull put. Close and do the opposite because the stock has moved against me. Now that I know what the stock's been doing, the risk there, of course, is it goes back the other direction. We lose on both sides, which might have happened to you had you done that adjustment when year 3 got hit. Another one is to just I could just buy to close the short and leave the long open if I think the stock might go above 36 by the end of next week. Hopefully the gain I have in the 36 call will counter the loss of the buyback. That's a risky one. You're just left with a long call. You need a bigger movement for the stock to continue to go. And in the put side, you do the opposite too. Okay? And that's the other one. That's a consideration. It's just buying to close the short, leaving the long open. Okay? Now, on a bull put spread, Randy, going into this view, this is our bear call. So those are another, I'm sorry, the last one is of the 7. There's 7 ways that you might be able to look to manage a credit spread position. The last one is what I call the pendulum adjustment. This works best if the stock is between the strike prices, which it kind of is here, but I'd really want it to be more in the middle. If it's gapped up to 34.80, 34.90, I'd look at it in this case here. What the pendulum adjustment is instead of closing out my bear call and now opening a bull put because my sentiment has changed, I'm going to convert this bear call credit to a bull call debit with one move. I'm going to sell to close my long and buy to open a lower strike call. So I'm going to sell to close the 36 and buy to open the 32. It's a swing. I'm moving the long option. Why? Because now I'm in a bull call debit spread that might give me a profit if the stock stays above 34.29. Okay? Call that the pendulum adjustment. And again, it's based on the numbers. Does it always work? No. But if the numbers are there, it gives you, you're rolling one option instead of liquidating and opening a whole new spread that's bullish. You're rolling one option, selling to close the 36 call you bought, and buying to open a 32. So with that one move, oops, there we go. You create a bull call debit spread. Why does it always do that? Now see, this one's interesting because it gives me a small profit of only $4. I just moved this call down, so I'm in a bull call debit, and if it continues to move up, I've taken what could have been a larger loss on the bear call credit into a gain. But of course, this one wouldn't have helped in your situation. Again, hindsight 2020, because it fell back down, so you were in this loss area on the position. So that's the tough trick. It does come down to where you think the stock's going to go next, Randy. There are ways to manage it. There are triggers that you want to use because the one thing you really can't do in a credit spread is let it go and take 100% loss. So that webinar is going to help you. I want you to take a look at it if you have the time. Just go to powerop.com/webinars.asp. Or on the main page, go to, I'm sorry, I still have the pen here. Yeah, on the main page, go to free webinars, of course. And then under the options strategies tab, there's a webinar there, on managing your spread positions. We talk a lot about the triggers, which you may or may not want to use. If you use other things, of course, if you use probability, you only look for positions that have a probability of 85% or higher. Well, if the short put that you sold drops to a probability of, let's say, 75 or 70%, you may consider an adjustment at that time, or probably 65%. Okay, so that might be something you might want to consider in that situation. There are ways to manage it without just closing the position. There are ways to adjust it. We saw that it didn't work in this case, but if I'm in a bull put or a bear call, if I leave 2 strikes between and I roll down one, in the bull put, for example, keep the long open, just roll the short down one, I still might have a profit. I've got a better profitability window in the sense that I've given myself more cushion for the stock to continue to fall. Now, depending on your outlook on the positions, depending on your account, depending on your outlook on the positions and depending on your account, it may be okay, more than the bear call credit spread, it may be okay to allow a bull put to go slightly in the money if you have the capital to buy stock. Because one of my rules of thumb for any investor doing cash secured naked puts or bull put credit spreads, a potential outcome of a bull put credit spread is that you may end up owning shares of stock. If the stock is between the strike prices at expiration and you forget to close it, or you just assume your broker is going to close it, well, if that short put's in the money, you get assigned, your broker's not going to exercise an out-of-the-money put for you. You're just going to be long shares of stock on Monday. Or if it suddenly gaps down and early assignment occurs and it's not below both strike prices, you own shares of stock. So you should never sell a bull put credit spread on a stock that you would not mind owning, meaning the criteria that you use to identify a bull put credit spread should pretty much be the same exact stock technical and fundamental criteria you use to identify a stock you'd want to buy. Okay, because that is a potential outcome. And if you're doing that, then it might be okay to allow it to be assigned. Again, depending, allow it to go a little bit in the money, Randy. And you might be okay to be assigned, depending on if you still think it's a good stock long term, that this is just a minor hit to the position. And of course, on the backside of that, the most important thing, you have the capital in your account to potentially buy those shares of stock that you're selling on the bull puts. And many might not because it might be overly expensive, but because you just want to trade spreads. You might have 15 to 20 spreads open and you're trading other spread strategies and leverage strategies, and you're not trying to keep $40,000 or $50,000 on hold to buy 1,000 shares of stock at $50, okay? Because you're using that capital to trade other positions and other leverage positions as well. All right, so that's just my thoughts. Take a look at that webinar, Randy, and just as I told to James, send me an email, give me a call. Go over the webinar first, though. We'll talk about the trigger points, we'll talk about the criteria there, and we'll talk about the 7 management techniques. And there's other places you can view quickly the 7 management techniques of a credit or debit spread. So you'll want to check that out. In your case, it was a tricky one because you did the right thing, and you did probably what I would have done. When you close the short or you close the bull put spread entirely because you're afraid of a larger loss, only to watch it come back up. And sometimes that's the nature. There are repairs we could have used in those positions, but we would have had to decided that it was the right repair for the stock condition, and that's harder to do. It really is. But some of these repairs can actually cause you larger losses if the stock goes back to where it was. And that's a tricky one. And what doesn't appeal to everyone, they are possible repairs. You could turn a losing trade into a winning trade if the stock continues to move down against you. But if you do that adjustment and the stock moves back up, you might lose more on the other side. And that's something that just comes and goes. It's part of all investing. Management techniques can add more risk to the position. Whether you're trading futures, whether you're just trading stocks, that's the nature of the game. All right, Rajiv, you said you had entered Pepsi in a diagonal call spread. All right, so let's go back to our custom spread tool here. I'll clear everything out. I'm going to take a look at Pepsi. I forgot it. PSI? PS? It's okay. PEP. I was thinking PES. Okay. All right. Pepsi. Now you did a June 105. Okay, June 105. Shorted. This is your short. It's the June 22. 105. 16 cents, I guess. And you bought July 2100 for 141. All right. Okay. And you say, what would be the best exit criteria for this kind of position? All right. So you can see that we're in this spread, but Pepsi is down to 97.43. Where is our target zone? When you open this position, Rajiv, your target zone naturally was somewhere in here. All right, that's where I wanted the position to be. It didn't work out. All right, here's one thing you have to ask yourself when you open this position. You've got time. Okay, it's out to June 22nd, so you've got time for this to recover and move back up where you want it to. You took a cheap out-of-the-money spread to look for a very high return. You're going for that 3-to-1 reward to risk ratio, which usually results in a low probability of success. You're in the red right now. Okay, so this is where we want to be. It's not there yet. but you've got time, okay? So what are the triggers here? Well, the trigger might be for this call, just like we talk about for any long call. If you had just bought the Pepsi call, Rajiv, this July 100 for $1.41, what would have been your stop or your trigger to roll it? If the stock hit X price, if the value of that call dropped 35 or 40%, okay, these might be triggers where you'd want to adjust the position at this time, maybe even 50%. So if this dropped down about 70 cents, then you might want to consider adjusting the position. Where was it now? It was the July 100, right? Yeah, so that's not bad at all. That's interesting. You actually have a gain on the call. That's kind of unique. So you could sell to close this for about $1.60, make 20 cents on the long, and it's going to cost you, all right, 22 cents to buy it back, so you give up 6 cents there. So you're at a profit on this position. I know it's not the profit you want, but you're at a profit. But where I'm going with this is it looks like you did an out-of-the-money calendar spread to really look for the higher return in the hope that it would move up. Well, it's not doing what you want. So the question is, what I'd look at is, where was the stock price when you did this? How far is it off of the stock price when you did this? Okay? And consider it just as if you had done a different diagonal spread or a bull put. If the stock moved down X%, what would your trigger be to roll the bull put spread or the bullish vertical spread? That might be something you'd want to consider here if it looks like it's already not going your direction. Number two, I would use the same stop that I would on a standard long call for this leap, or at least a trigger. So if you just buy a call and your stop is 40, 45, or 50%, if I see this drop to 40 or 50% of what I originally paid for it, I'm considering rolling the position, adjusting, or getting out of it. Again, depending on how you set this up, Rajiv, did you look at delta ratio? If you had a delta ratio, say, of 1.5 or 1.4 between the long and the short, I usually look for 1.6. But if you had a delta ratio of 1.4, but now it's dropped because the stock has fell and it's only 1.1 or it's dropping below 1, that might be a trigger if you use that. Or implied volatility ratios might use that as well. But you set this up to put time on your side. It's a short break between the two options, right? It's about 30 days just between the two. But you're 45 to 60 days out in time with this 22 of June. And it looks like it's at a profit to me right now. So right now, I don't know where you originally got this with the stock, but right now I'm not worried about managing it because you're at a gain. It's still going in your desired direction. Oh, I'm sorry, it's not going in your desired direction, but you still have a gain right now, but you set it up so that you want it to be here. Give yourself time, with setting also triggers that if this continues down to maybe 95, or this drops to 40 or 50% of its value, the long option, the investment part of this position, if it starts moving too far away from you, start seeing too much of a drop, or if you use delta for the long as a goal to get in or as a criteria to get in the position, use the delta as a trick to close out of it as well. Okay. And so you said you did the same kind of thing here with Disney, with a 102 June 29, 105. I'm sorry, 102 for June 29. Wow. You bought the 102 for 29 at 285, and you sold the 105 for 120. You're looking for this high return with hoping the stock continues to grow, which has a lower probability of this happening. You have the lower probability right now as well. So in that case, I'm sorry, it was for Disney. Let's just go here, Disney. And it's currently at 101. And it's up 239 today. So again, I mean, you've got the time on your side, and it's starting to move in the direction that you wanted for this position. So I'd say just leave it open and let it get close to there on that situation. Let it get closer to those positions also. Pepsi was at 96.75, you said. Okay, good. So, it's fallen, but the position is still at a profit. for that Pepsi original diagonal spread we were looking at. And you were looking to make an adjustment, it moved to 99. Yeah, but you've got to be concerned maybe if it continues down to 95 or so that you may want to adjust it. But again, I'm sorry, based on that view of what are you willing to lose on this position, if that hits, you might want to adjust it or just get out of it to prevent larger losses on this diagonal, because you can still lose 100% of it. You can still lose the full 125 if it quickly continues down. I'm not saying it's going to, but you're taking a chance here. Instead of looking for a position that has a 3-to-1 risk-reward ratio with a 70-75% probability, you're looking for a position that has a 3-to-1 reward to risk ratio, but only has a 20 to 25% probability of getting near that max return. Okay, so you're playing the numbers game the opposite direction of typically what I do. And if you're in a bullish market, as we were over the last 2 years, that would have worked really well. But there's a lot of, as caught up to Randy, we talked about with the spreads, there's been a lot of helter-skelter the last 2 months. That February 5th to February 9th decline of about 11%, and then again from March 20th to April 5th. And we started to come out of that again. A little hiccup was there in the middle of April too. But it's been looking good the past week. So these are set up to be very profitable positions if that trend continues. But as far as management and what I do, it'd be based on the triggers, the stock price when I did that. No, Rajiv asked a very, I don't want to say difficult question, but it's a question that's related to the radioactive trading and the income methods. And let me just take PHM, which has moved up nicely, which I should have want to manage soon. But one of the positions I considered here is income method number 6, what we call bear call spread. It's a bear call spread on top of the married put, but it leaves me with infinite upside position. And this one's not great, but we'll put it in. So what I'm doing is I'm going to do a bear call with a 32.34. Okay, I'm selling the lower strike as I would in a bear call and buying the higher. Now this gives me a little bit of net credit. Right, I'm getting about 30 cents here, paying 4 cents, 5 cents here. It's really about 4 cents. Anyway, so I'm getting about 26 cents of net credit. Not a lot, but what it does is it leaves the upside open. If this suddenly gaps up against me and goes to 35.36, if I just sell the 32 call, I get a higher premium of 30 cents versus 26 cents, but my gain is capped, and I can have a loss to the upside. The bear call spread leaves it open because the short call that I have here is only obligated by the long call or by the stock, not both. So if the stock does continue to move up, either this long call or the stock I own is going to continue to gain unhindered by the short call, which will be covered by the other one. Now there's a different income method where we use that ratio repair that we saw before, income method number 5, but it's done differently. Rajiv's question is there, can you convert the bear call and the married put to a ratio call spread? Let me go back. No, let me keep this one. Okay, let me keep this example. Let's say before I had actually done a bear call for May 18th where I sold the 31 and bought the 33. And it's about same net credit. Let's say I got 35 cents, paid 8 cents. Okay, and now the concern is the stock. See, I never would have done this. Obviously, I never want to just collect the credit if I've got increased risk all over the board. But again, in any case, let's say that I had done this. Now remember, Rajiv, there's a trick to the ratio spread. In the bear call, you're selling the lower and buying the higher. In the ratio, you're selling the higher and buying the lower. So you can't do a 2-to-1 here unless you close out the entire position and then buy one and sell 2 33s, right? Because this one, oh, sorry, folks, this one's a bought. It's not a sold. You want that one to be sold. What I might consider now, and this isn't far enough to do it, what I might consider now is buying back the 31 and selling 2 34s. Okay, so now I convert here, but I have to move the strike above to where my existing long is, and now's not the time to do it. If the stock was at 33, 33.50, that would work. But converting it to the ratio spread, we are selling the 2 higher and buying the 1 lower. You've bought the 1 higher. The only way to convert it is to take out everything and redo it. Or this is a bad idea and it would never work. Sell to close this. Sell another one of these and buy a 30. It wouldn't work out though. I've tried it before. It's not a good position. Let's look at it. Okay, so what am I going to do? The stock's moved up. I'm going to buy to close the 33 first for May 18. I'm sorry, sell to close. My apologies. A sell to close that. Okay, now I'm just left with the covered call position, collar. Now, that stays. May 31 call. I sold one. Guess what? I'm going to convert that to sell two. Now it's going to look really ugly for a moment, okay, because I have infinite risk to the upside. But to counter that, see how confusing this gets, Rajiv? And now I would buy the 30. All right, so what do I have now? In a sense, I have just 2 31 calls and 1 30 call. I did that by selling to close the 33, selling an extra 31 and buying a 30, and it's still ugly. It doesn't work. Don't use 5 to try to repair 6. Don't try to convert a 6 into a 5 or a 5 into a 6 because they're originally different structures. It doesn't work that way. The only way it would work was to cancel out of the bear call and create a new income method number 5 if it matched your direction and your SIGA model for the position, okay? So that's just, you're mixing two things that aren't the same structure. Okay, the bear call does not easily convert into the ratio call spread because the strikes are different. The one you've bought and the one you sold for both the 5 and the 6 are opposite. So you've got to reconvert everything, and it doesn't pan out. It doesn't pan out, okay? Adding just an extra long call to the 6 or converting a 6 to a bull call debit is something that's discussed in the radioactive trading techniques. And converting it into one of the other income methods potentially is 11 is discussed as well. And perhaps income method number 8. But don't try to fix a 6 by converting it to a 5 or fix a 5 by converting it to a 6 because your strikes are completely different. Okay? You're more looking to create an 11 if a 5 goes against you, and that's talked about on the Mastery Series video, I believe, the 5 ways to manage income method number 5. Let me think. Yeah, I think that's discussed there. Okay. Well, ladies and gentlemen, I don't see any other questions that have come in. I'm sorry, I just wanted to mention that for those of you that have not done so yet, want to make sure that you go ahead and you can go to PowerOp.com at any time. Just put in your first name, last name, and email address, and I'll give you a full 14-day free trial to the service. So if you haven't tested it out yet, you can use the search tool that we didn't really look at today, but we talked about a little bit in the diagonal spreads. We do support over 23 of the commonly used strategies with the various stock and option criteria you can enter at the same time. But you can get full 14-day access, no credit card, just first name and email address. The subscription services after that start at $40 per month, and that's just for the end-of-day service. But most of you are probably looking at the delayed service, so all of the data is updated at 20 minutes, 15, 20-minute delayed. You get access to all the search tools, all the analysis tools, and that's $60 per month. And of course, we do offer a real-time service as well. So every time you refresh the page and run a search, you get the numbers and calculations at that very instant. Remember, you can check out the blog at any time, blog.poweropt.com. And as mentioned, you're probably going to want to check out the webinars page, poweropt.com/webinars.asp. Full videos there on things we talked about today, managing your spread positions, managing your long call or long put positions that go against you. And of course, you can check us out on YouTube under User Power Options. And there's 2 recent just 2-minute videos that we put up, quick diagrams of the 7 ways to manage your bull put credit spread and bear call credit spread as well, in addition to all of our other Friday archive presentations that are public on our YouTube page. When you think of a question or something you'd like to discuss later on, remember, send me an email at any time to support@poweropt.com or support@radioactivetrading.com. During the trading week, you can also call us during market hours at 302-992-7971, as we talked about with James and possibly Randy as well. Trial members and subscribers, you can schedule a coaching session at any time. It's just, as I mentioned, a 35, maybe 45-minute phone conversation with myself or Ernie. We will walk you through the tools on the site and answer any questions that you have regarding strategy, management, ideas, and so forth. Well, ladies and gentlemen, thank you all for joining me today. Thank you all for your questions. Hope you all got some useful education out of today's presentation. I look forward to seeing you on some of our online webinars coming up in the future, our live presentations. Have a fantastic weekend, a fantastic Mother's Day. We hope to see you soon. Good night.